Hey Bowtie Nation, Joseph Hogue here with the Let's Talk Money channel and a video coming straight out of a question from our Facebook group, Let's Talk Money Together. Thomas says he's 67 years old, no debt, and needs to invest $250,000, and where should he put it? And it's a great question, not just as an opportunity to talk about where to invest your money, but also that risk-return trade-off. Because Nation, the market lately has been all return and no risk, straight up and to the moon. But that's not always how investments work. Look at any 10 or 20-year period of the market, and it's as jagged as the Himalayas with peaks and crashes everywhere. So today, I wanted to give you a countdown of 7 ways to invest for different levels of risk and return, a way to fine-tune your portfolio depending on how much return you need and how much risk you can stomach. We'll count down from the lowest risk to the highest return, showing you exactly where to invest your money, how to do it, and what kind of return you can expect on each. Stick around though, because towards the end of the video, I'll also reveal how to put it all together for a perfect, low-risk, high-return strategy. We're getting started, but you know I gotta send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. Number 7 here, Series I bonds. And ironically, the lowest return on the list is the one I'm most excited to talk about. Nation, I bonds have been called the market's best kept secret. You won't hear about these from any financial advisor because they don't earn any commissions or kickbacks from it. You can invest in these for free straight from treasurydirect.gov, and it's the best risk-free return you'll ever get. Now, the 10-year Treasury bond has been called the risk-free asset because the government can always just print more money, so there is 0% chance of not getting paid back. But the 10-year right now only pays a 1.5% interest rate, which is less than you lose each year to inflation. But then here's a better option. In fact, not only is this investment totally risk-free, but it pays twice that return and gives you a tax break. The Series I savings bond was introduced in 1998 to help small investors earn a return and fight inflation. The bond earns interest at a fixed rate, plus an inflation kicker that is adjusted every 6 months. And I bonds are currently paying 3.54%, which is the highest since 2011, and that's bound to increase as inflation heats up. Now, Nation, I know this isn't as sexy as talking about growth stocks or the potential to double your money in some of those penny stocks, but to a money nerd like myself, this is like Christmas, July 4th, and my birthday all in one. You can invest with as little as $25 and with no cost directly from treasurydirect.gov, and each I bond pays interest for 30 years. That's a guaranteed return plus inflation protection for 3 decades. Now, as we say here on the channel, it's not all rainbows and unicorns though. You do have to hold your I bonds for at least 12 months, and you give up 3 months of interest if you sell within 5 years, but that's a pretty nominal fee. The average savings account pays just 0.04% right now. So this is a way to get that same risk-free protection on your emergency savings, but make 88 times that interest rate. Number 6 on our list of where to invest money is a way to get twice that return on your cash. Now, BlockFi is a cryptocurrency platform, but also offers a way to earn more than 8% on your cash and still keep it safe for when you need it. Now, I earn interest on my Bitcoin and Ethereum, but if you scroll down on the rates here, you earn 8.6% on USDC, GUSD, and Pax coins. Now, these are all called stable coins because they hold their value with the dollar. For example, the USD coin is valued at $1 each and is backed by a reserve of dollars, so that digital token stays exactly at that amount. It's essentially a digital savings account. So then depositing your money into a BlockFi account, you convert it into these stable coins, and it's just like having another savings account, but one with an interest rate that is more than 200 times that you'd get from a bank. And BlockFi can offer those higher rates because it lends out those stable coins in its vault, and there is a huge demand for liquidity right now from institutions, investment managers, and money managers. Now, that's not saying that 8.6% interest rate is without any risk. While these stablecoins do keep their value with the dollar, the account isn't FDIC insured like you get with your savings in a bank account. Now, BlockFi is regulated by the New York Department of Financial Services, but is not a bank. Now, just like with any savings account, you can withdraw your money at any time. BlockFi allows 1 withdrawal a month with no fees, and then just $10 if you need more than that each month. Now, I know it's a new idea for most people, so I'll leave a link in the video description below to find out more. We've still got 5 more ways to invest, and here we're getting into those riskier investments, so I want to get your opinion on this. Which of these investments are that right level of risk for you? So watch through the list and let me know in the comments below, how much risk do you want in your portfolio and which of these is best for you? Number 5 on our list is a great way to get higher dividends on your stocks with preferred shares. Preferred shares are a special type of stock with rights that go way beyond those normal shares. Preferred shares have a set dividend yield and a payment that must be paid before regular stockholders get any of their dividends. Now, these investments usually offer a much higher dividend as well. For example, Bank of America issues preferred shares paying between 6 to 7% dividends, while its common stock pays a dividend yield under 3%. And preferred shares are also higher up on the list of liquidation. So if a company does file bankruptcy, preferred shareholders get paid before those common stockholders, but after its creditors. Best of all, though, is that the preferred shares also enjoy some of those growth benefits of regular stocks. And most preferred stock is convertible into regular stock if the share price reaches a certain point. Basically, the company is saying, here, enjoy this higher dividend yield if the stock price goes nowhere, and potentially higher returns if the shares take off. And just like with bonds and stocks, you can buy preferred shares on any investing platform, but the best strategy is going to be through funds holding a portfolio of these preferred stock. You get instant diversification along with the preferred shares of hundreds of companies, along with higher dividend yields. So an example here would include the iShares Preferred and Income Securities ETF, ticker PFF, which pays a 4.6% dividend yield and a total return of around 6% annually. Next on our list of where to invest, one of my favorite asset classes with real estate and real estate platforms. Now, all you out there in the nation know how much I love real estate investing. It's where I got my start as a commercial property analyst. I've managed my own rentals, and no other asset class has produced as much long-term wealth. And according to a Bankrate survey, Americans have more in real estate than any other investment. And we've talked about those real estate stocks on the channel before, but another alternative is in these property platforms like Fundrise and Streetwise. Now, I really like these alternatives because it gives you the opportunity for those high real estate returns, but without the big down payment that you need to buy property directly. These are professionally managed funds that own the properties and then pay out those dividends just like those REIT stocks. The only difference here is that these aren't publicly traded on the exchanges, and the funds tend to hold fewer properties. So one example here is Fundrise, which I've been using since late 2019. I started with $1,000 and have collected $84 in dividends and $85 in appreciation. So a 10.7% annual return on my money. And what I really like about Fundrise is this transparency. You get updates on all the properties. The platform shows you which investments are debt and which are equity. You can even click through here to get a full description of each property, including market analysis and the financials. And then because these are smaller portfolios of properties, the managers can focus on only the best returns. I own several REITs in my stock portfolio, and my Fundrise account beats most of them with that double-digit return. Now, Fundrise has different property portfolios you can choose from, some focused on higher dividends, while others target that price appreciation. The platform has a new program also. It's 90-day guarantee. Get started with as little as $500, try it out for 90 days, and if you don't like it, Fundrise is going to give you a full refund. It's a great way to try it out risk-free and start building that real estate portfolio. So I'll leave a link to Fundrise in the description below if you want to check that out. We've still got 3 more of those investments to highlight, plus that special strategy, but I want to personally invite you to get the Daily Bowtie, our daily market newsletter sharing the most important news, strategies, and tips straight to your inbox. It's totally free, just something I like to do for all you out there in the nation, so look for that free sign-up link in the video description below. Third on our ways to invest is also in that real estate theme, but with a higher return and lower risk in property tax liens. Now, not only are tax liens a high return investment, but also one of my favorite passive income sources. So anyone that owns their own home knows that the county collects taxes on every property in the district. If those taxes aren't paid, a lien is put on the property and it can't be sold until everything is caught up. But the county needs that cash now to fix the pothole on Elm, so it's going to sell that lien to an investor at an auction. The investor buys the lien and collects the interest rate plus the lien amount over a period of years. And what's great about these is that the county is going to collect those back taxes and passes that amount owed on the lien directly to the investor. If the lien isn't paid, you might pick up that property for pennies on the dollar. 29 states sell tax liens, while others sell the deed outright, and some do a kind of a mixed approach. We'll look at the process for liens because that's really the lowest risk and a great investment. Understand also that you don't need to be a resident of that state to buy the tax liens. In fact, Iowa boy here, I used to go to Cook County in Chicago and Fulton in Georgia all the time to buy tax liens from those states. Now the interest rates you collect on the liens ranges from 10% to as high as 36% in some states, and the time owners have to redeem the liens can go as long as 4 years. That means you could lock in that interest rate for years to come. Now, tax liens work in a couple of different ways depending on the county. If a property owner falls behind on their taxes, the county puts that lien on the property and then puts it on the list for the annual auction. Now you have to register for these auctions and grab a list of properties, sometimes months in advance here, so make sure you're planning ahead. Pros of this tax lien investing are that high rate you collect. I've earned as much as 24% on some of these liens. It's also almost completely passive, since 90% of these things get paid off by either the homeowner or the bank. Cons though are that it does take some research time to sort out through all the properties, and you might have to travel to different counties or states to find enough to invest all your money. And some of these liens are in the thousands of dollars, and you'll need to keep up with those subsequent taxes as well. And 2 more high return investments before that special strategy. And the next on our list is value stocks. And I wanted to include value stocks here because while they do offer that upside return of stocks, they're lower risk than some of the other types like growth stocks or tech. Value stocks are those with lower price multiples, like price to earnings ratio or price to sales. It's stocks of companies selling at a discount compared to other companies in the same sector or the industry. And now that last point is much more important than most investors realize. While sectors like financials and healthcare tend to have stocks with lower PE ratios, so selling for a lower price on their earnings, you can find value stocks in any sector of the economy, including tech stocks. Just remember though, always compare stocks against those in the same industry. So if you're comparing shares of Facebook with its price of 30 times earnings against, say, shares of Bank of America with a 17 times PE, then yeah, Facebook seems wildly expensive. But then comparing Facebook against other stocks in its industry, so maybe Google parent Alphabet with its 33 times price to earnings ratio or Amazon with its 65 times price to earnings, Facebook is actually the value play in that sector. So you can still be a value investor looking for those discounts and also have those tech stocks or growth areas. And while everyone likes to talk growth stocks, value has actually beaten it on long-term returns. Growth has done well over the past few years, but value stocks have beaten it by 4.5% over more than 80 years. And finding these value stocks is as easy as just comparing 2 numbers. You can go here to Yahoo Finance or any investing platform. Look for the price to earnings, price to sales, or price to book values, and then compare stocks across each industry to find the best deals. And our number 1 way to invest for the highest returns, penny stocks with an annualized 27% return. Now, penny stocks are generally any company with a market cap under $500 million. So you're looking for small, fast-growing companies that can someday be the next Tesla at $660 million market cap, or an Apple at over $2.2 trillion. Pros of investing in penny stocks are just that opportunity to get in on the next big thing before it becomes that $2 trillion Apple company, or before the 4,000% return on shares of Netflix over the last decade. Investors also like the excitement of investing in a penny stocks and the fact that you're supporting smaller companies as they grow. But there are some downsides to penny stocks as well. First is just that volatility in these and that other side of those big returns. Even on some very solid returns over the last year, 7 of the 17 penny stocks we've recommended on the channel are in the red by as much as 18 and 23%. And this was actually the bulk of my job as a venture capital analyst, finding these small pre-IPO companies or those new penny stocks and digging into the financial statements, separating out the best and making recommendations. But that extra work does pay off. The average annual return on venture capital and angel portfolios is around 27% a year, nearly 3 times the market average. Even these small cap stocks in general tend to beat the market, with the Vanguard Small Cap Growth Fund beating the S&P 500 by over 43% over the last decade. Penny stocks can make you rich. That outperformance on the small cap fund would turn $200 a month into $187,000 over 20 years, 80 grand more than investing in the broader stock market. But investing in these penny stocks, the smallest of the small cap companies, that could grow a portfolio to over $1 million in that same amount of time. We've got a lot of great penny stock videos here on the channel, but you can screen for these on any investment app. First, look for stocks with companies under $500 million market cap for that small company flexibility. I also like filtering for companies growing their sales by at least 20% a year for that faster growth, and then a strong balance sheet with more cash than debt. Now that's important here because these small cap companies, they need that cash stability to survive. Okay, so that was a lot to take in, and I do see a few eyes glazing over out there, but don't feel like you have to pick just one of these to invest in. In fact, the best strategy, the one that will give you the highest return with the lowest risk, is to pick a few of these to combine. And what you want to do here is find your tolerance for risk in this list of ways to invest. Where's that investment that isn't too much risk or not enough, but just right? Then use it and the 2 or 3 investments around it to build a portfolio that will not only give you a great return, but also is going to smooth out the risks in each investment. And this works because many of those investments react differently to the economy and don't rise or fall with each other. In fancy investing jargon, we say they're uncorrelated. So investing across 3 or 4 of these is going to smooth out the ups and downs in your money because some of them are going to keep rising even as others fall. It's a great way to lower your risk, but keep the return. Click on the video to the right for 12 dividend stocks that will pay you every single week. A complete dividend portfolio for weekly cash flow. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.